Thanks for tuning in, and in this video you're going to learn about an interesting moving average that was designed to reduce lag but still keep the smoothness of the trading indicator. Now, moving averages, we all know that they come in different types and they all lag price, right? Trading indicators do. They need price. Take the simple moving average, for example. That weighs each price point equally, so it's going to lag the most. You got different twists. You got the EMA, you got the WMA, and these ones evolved, but they just emphasize price differently. Now, the Hull moving average, that was developed by a gentleman named Alan Hull back in 2005, and it reduces the lag from the current price levels the best without looking too choppy. Now, here's the formula to calculate the Hull, and it also includes the weighted moving average, and you can see there's a whole bunch of different things here. Also got square root is being used. And here it is on the 4-hour futures chart. And you can see that the Hull smooths the data closer than the other two averages, and why it's popular. You know, we have the HMA in the blue, we have the SMA down here in the black, and the EMA up in the green. Now you should be able to get this indicator on virtually any charting platform, free or paid, doesn't really matter. Well, how do we use the Hull moving average? Well, we can use it for trend direction like we can every other moving average. And most traders like to use averages when they do for trend direction. And generally, you're going to want to use a longer setting to determine the trend direction, as opposed to using the default setting of this indicator to 9. So in this example here, we're going to use the slope of the 50-period Hull, since that's a common SMA EMA period that's being used. And traders would want to use that general slope of this average, since it does track price pretty close. You can see how close it is to price. So when we have it sloping down, we're only going to consider shorts. And when it has it upsloping, HMA, which is the Hull moving average, traders are going to look for long trades with any number of trading strategies they're going to use. Now, the Hull uses the square root. So you might want to consider only using numbers that you can square, such as 4, 9, 16, 25, 49, 81. Now, moving average crossovers, they're pretty popular to people. So let's take a look at what that would look like. And for this one, I'm just going to use a 16 period and a 49 period. It's pretty close to the 20, 50 that people use. So short is when the 16 crosses to the downside of the 49, and long when the 16 crosses up over top the 49. So here we're just going to look at long only trades, okay? And there are a lot of crossovers, and this is a daily future chart. It's gold. And there are some in direct violation of the longer term trend, as you can see. Now, interesting enough, Alan Hull did not recommend using crossovers as a trading method. Why? Because the crossover itself produces lag, and that was one thing he was trying to get rid of with the trading indicator. So I just ran a quick back test on the gold spider, and it was over 4 years. It was only trading longs. You had to enter by the next open after the cross up, and you would exit when the price low was less than the 49 period. And here's the results. Net profit 13.57%, but buy and holding through that time was 33.97. It took 48 positions, only 38% were winners. The average drawdown was 11%. Average win was 2.6. Average loss was just over 1. And the average return was 0.35%. Now, that's just rough numbers. Nothing was optimized, but it could just give you just a rough idea of using this moving average in a crossover way. But remember that trading, it's about probabilities and having an edge. So just ensure that you know what yours is before you start trading. A lot of people ask, what's the main difference between the Hull and the Exponential? Because the Exponential is a little bit quicker. Well, really, it depends on how you use it. So if we look at it from a day trading perspective here, where when the trend changes and how quick that happens, and you're notified of that, it's going to really matter. So this is a 5-minute intraday stock chart of Tesla. Now, it depends on the trading strategy you're using. Okay, so the HMA, which is the blue, that alerted you with lower price points if you're looking to buy due to the formula that's being used. So you can see over here on the left, 804, I think it's 17. Meanwhile, the cross was 809.79 on the EMA. And right here in the middle here, we had a cross up of the HMA at 785.43 and $10 higher using the EMA if you're looking for long trades. So, whatever you're using for your day trading strategy, some will use this chart for a trend and they'll use a 3-minute trading chart for decisions. But this example was just designed to show you that you're going to get a bit of a bargain when you're using the hull. Now, there must be a different way we can use them, right? Like we don't need to work always on crossovers. Well, let's look at multiple moving averages without a crossover. So we already know that the Hall average has an advantage over other types of moving averages. So let's use that to our advantage in a day trading strategy. So due to how quickly this indicator reacts to price, the average settings intraday, well, something you're going to want to consider. Just don't spend too much time trying to optimize it. So for this example here, for trend direction, I'm going to use a longer term one. So it's 81. And I'm going to use a short term one, 9. That will get us into the trades faster. So there's a few ways that we can trade this. We could enter when that fast, the 9 period HMA, flips in the direction of the trend. We can enter when the price breaks below the fast HMA, because this is a downtrend here. We can enter, if we want, to use crossovers on the first position in a trade through the crossover and then use the hooks in the HMA to add on. And exits, we can use different ones. We can use a break above the fast average. We can use a crossover, or we can just use a touch of the slow HMA. Now listen, there's no best setting for the moving average, so don't try to find one. It's really going to depend on a lot of factors, including how much you want to trade, so how often, the markets that you trade, and what you can handle psychologically. But look, with any trading strategy, it doesn't matter what it is, you're going to have to backtest your trading rules before you use real money. So let's wrap this up. I think it does a really good job of reducing lag, as well as it smooths out the price data. And it's not intended for crossovers, because that increases the lag. There are still trading strategies such as pullbacks, the breaks of the average that you can use. You can add different indicators if you like an oscillator, but just keep in mind that the more you add, there's more risk of over optimizing something. There's just more details that you have to worry about, more variables. Before you really trade the futures, understand the market, because there are such things as expiration and contract sizing that you should be aware of.